Welcome to the Property Investing Roadmap Podcast.
I would say once the thought is in your head, we would like to invest in some property, have the conversation.
Make time and discipline your friend.
I'm your host, Damian Collins, here to help you navigate the twists and turns of property investing.
The true investors are the ones that ask the right questions, but then make a very quick decision. And they're the truly wealthy ones.
For real success, you need a real strategy.
Buckle up as we hit the road with expert tips, real life stories, and the 9 key steps to help you plan, build, and optimize your property portfolio.
No one's going to invest to make a loss. You're going to make profit.
Welcome back to another episode of the podcast. My name's Damian Collins, and today we're going to talk about a topic that some people find perhaps not as exciting as I do, and that's because I'm a reformed accountant, and we'll talk about that today. But we're going to be talking about tax advantages of property and why that is so important when you're building your property portfolio to utilise the available tax deductions and help with your cash flow. So we're going to talk all things tax, and I'm delighted to have with me today James Ting from More Australia. Now, James, you've been an accountant. I won't ask for how many years, but you look very young, but I'm guessing it's at least a decade or two in it. But just tell me a bit about your background and what got you into accounting and tax and what you do in your accountancy role at More.
I'm often asked this question, what do you like? And, I like walks on the beach, beautiful sunsets, but in all seriousness, I got into accounting because my mum told me, don't become an economist, you'll be unemployed. So I did accounting instead. Been doing it I got my 25-year commemoration of being a chartered accountant 2 weeks ago, where I felt very old in the room. So I've been doing it more than 25 years. And the day in the life of an accountant is not quite the sitting in the basement with the cap and the little light and the pen in your ear. It's a bit more exciting than that.
They give you windows, do they? Really? Yes.
Actually, we've had to improve working conditions over the last 25 years.
Look, I am a reformed accountant, and some of the listeners may know I worked at one of the big four firms back in the 1990s, and also did my chartered accounting, James. And look, I think it was a great grounding for business anyway, in terms of what I've done, and certainly building a property portfolio. It's been really critical to understand the income tax implications. And look, there's always in the press, it comes and goes all the time, negative gearing, should it stay or go, capital gains discounts. We'll talk a bit about that today. But maybe just talk us through, for listeners who may not understand it, tell us about what negative gearing means and how that works in the context of property investment. Obviously, it can work for shares as well. It's not just property. And just tell us why that's an important part of cash flow management.
Yeah, okay. So negative gearing is an interesting one. It's unique to Australia in that you make a loss on your rental property. Not often is it all cash. There's a non-cash element, the depreciation part, particularly on newer builds. And you're allowed to offset that loss against your other income. Now, in other economies, that's not the case. A loss is quarantined or you can't offset it against other income. So it's government's way of indirectly subsidising rents and getting investors into the property market, which is essential really for Australia.
I spent some time in the US, and they have passive loss limitations. They let you claim, I think, 25,000 passive losses against your, at least that, when I last looked at it, that might have changed, against your ordinary income. We don't have any limitation on it. But what people, I think, don't realise is that when you look at the average rental yields that we get in Australia, which means why rents are, people wouldn't say they're cheap, but why rents as a percentage of the value of the property are a lot lower is because of negative gearing, isn't it? Because people were willing to take a lower rental return and make a loss on their property on the punt that it'll go up in value well more than the losses that they get back on their tax. And in terms of negative gearing, if we don't have negative gearing, as an investor, I'd go, well, I'm not getting any tax back on this. I would want a higher rent. And ultimately, I think if we got rid of it, that's what would happen. But look, we could debate that all day. Today is more about the tax component. In simple terms, I guess, just for the listeners, let's say you're in a 47 cent tax bracket, you make a $15,000 loss, you're still not getting all your money back, are you? So that's why it's important about obviously the capital growth on the property. But if you lost $15,000 and you're in the 47 cent tax bracket, you're going to get $7,300 something odd dollars. I'm trying to do it in my head as we speak, but you're not going to get all your money back, are you? All those losses back.
Yeah, that's right. I mean, it's all very timely. I picked up a copy of your book recently, and I actually passed a copy to both my kids, one each. And if I look at what you wrote in your book, it's stuff that I've learnt over 25 years, really, about property investment, how it works. And negative gearing is an important part of it. And as far as whilst you've got strong income, you can fund the loss, and you're punting on the growth in the capital value improving, so you can afford the loss during that period, and the gain is only taxed at half. So you're getting a whole for the loss, paying tax on the half. That's really what makes the investment stack up. We see other countries, as you said, rental yields as a proportion of values are definitely higher. So it is subsidising the rental market, and we saw the social experiment of the late 80s, early 90s, where they got rid of negative gearing for a period, and they backflipped within 6 months because people couldn't afford the rents.
Yes, I remember that. I was in school way back then, and the Prime Minister at the time, Keating, said, we're going to get rid of it. It's a giant tax fraud. And 2 years later, he brought it back for those exact reasons that rents went up. Now, for your investors, what do you think about? Well, firstly, can you explain PAYG variations, and do you generally bother with those, or do most people just wait to the end of the year if they're going to have a loss and get a tax refund?
Okay, so you've got two choices. If you've got a negatively geared property, you can either bank the loss and at the end of the year when you lodge your tax return, receive a larger refund, or if you prefer to keep the money in your pocket now rather than pay the tax man early, you can do what we used to call a 221D variation. I think they're just called PAYG variations now, where you can choose to have your employer deduct less tax throughout the year. I guess if you've got good discipline, fiscal discipline, you can do the PAYG variation because it's better in your pocket, reducing your rent or reducing your interest maybe on a home loan or other investments you may want to put your money into. For most of our clients, they may not have the same discipline. They'll wait to the end of the year and get the refund.
I think it's an important point. Yeah, in a perfect world, you would take your PAYG variation. Let's say you're going to get, simple terms, $10,000 back. You'd get $200 a week back. You'd put it in your offset account on your home loan, perhaps, and that would probably save you another $500 or $600 a year in interest. So, from a pure mathematical point of view, it would make sense to do it. But however, for most people, that you have to be obviously somewhat disciplined to buy an investment property and do that in the first place. But for most people, it's they may end up spending that money. It may not end up in their savings. So look, it's a personal choice. If you feel you're super disciplined, I think it's worth investing in doing the variation. But if you think you might end up spending it, well, that nice lump sum at the end of the year when you lodge your tax return always comes in handy, doesn't it, James? But I want to talk about the really important part of property investing, and this applies to commercial property and applies to residential, although there are some there's been some changes in the laws around depreciation on residential, but is depreciation the fact that you can get a deduction for money that you actually haven't forked out in cash. It's in the purchase price of what you've purchased, or it could be that you've done some upgrades on that property. So do you want to, there's two parts to it. So obviously there's plant and equipment depreciation, and then there's building. Let's start with building depreciation. So how does that typically work? And maybe you can just give us an example of some approximate numbers on how that might work for an investor.
So property depreciation is generally at 2.5% straight line, and it's based on cost of construction. In most cases, we'd recommend clients go and obtain a quantity survey report to quantify that, and that's usually the big win for most people in terms of the non-cash deduction. If you invest in a relatively new development, which was constructed over the last few years, your depreciation deductions, which you've probably borrowed money to invest in, are quite high, and you're getting a tax refund. And in some syndicates, you're actually getting a physical cash distribution of that amount coming back to you over the life of your investment.
It's an interesting point. So I've got a residential property that's quite expensive to build. I'm getting a $25,000 a year depreciation allowance. So effectively at 47 cents, I'm getting back $12,000 and a bit each year as a tax refund, I haven't actually spent any of that money. And the value of the asset is going up, albeit most of it's the land going up, not so much the building. So it's when you've got a property in your own name as a residential, it certainly can be very powerful because you're getting cash back and a deduction for something you haven't necessarily outlaid in cash. I think also that you mentioned there in commercial property, it's important as well because whether you buy direct or through the syndicates, certainly in our Westbridge business unit, in some cases the depreciation, because that you might get a 7.5% distribution, but that may only be taxable to 40, 50, 60% because you get the pass-through of the depreciation. I think that's one of the really powerful things about property is that ability to get those non-cash deductions. The government, quite a few years ago now, they made some changes to depreciation on residential properties. Do you want to just tell us how the rules now, it's not the building depreciation per se, but the plant and equipment. Do you want to tell us how the rules are now different in residential, whether you buy brand new versus buying an established property on plant and equipment?
Yeah, it used to be the case. I mean, it's probably changed a few times. If I go back to it would have been early 2000s, there was a quirk in the law where you got a free kick on building depreciation, actually, and it didn't even reduce your cost base. So not only did you get a tax deduction, you preserved the entire cost for capital gains tax purposes. Government recognised that and repealed it, so your depreciation does reduce your capital gains cost base, which makes sense. It's a equalisation on both sides of the ledger.
I think that one, though, if particularly for most investors, if they're investing long term, it's something that'll come back around, but it might be 20 years. So I don't think that's, you'd rather they didn't reduce your cost base, but generally to me that's a fairly small thing in investing.
Correct, and that was probably more a quirk in the law, an unintended consequence. But more recently, it probably it would have been, I'm saying mid to late 2015 to 2020, around there, they changed the law such that any depreciable items that were acquired as part of a second-hand purchase couldn't be depreciated except for building depreciation. Yeah. So what was historically the case was any building always got a depreciation report, and there might be a lot of plant and equipment you claim a deduction for there. That was largely gone. So now if you buy second-hand, if you buy new plant, you put a new fridge in, new washing machine, new air conditioning, then you get a deduction for it. But if it's already sitting there and existing, you won't.
That's an important thing. So they're obviously trying to encourage new supply, and that if you buy a brand new property, you obviously get those deductions for all those items. And it used to be quite substantial when I bought property before these changes came in, and you would get your quantity surveyor report, and they would then do talk about the plant and equipment. There's all this low value pooling and all these other different things. It was quite substantial. If the property was reasonably modern, particularly, it was carpets, blinds, anything that basically wasn't bolted as part of the premises. So look, that was a bit of a cash flow setback, but nonetheless, that's certainly hasn't impacted investor appetite for property. Potentially has pushed some more people into newer properties, but ultimately hasn't had that much of effect. Now, James, I want to talk about capital gains, and this is one of the things that I talk about in the book about one of the great things about property, and it's any asset, and it can apply to any asset, but particularly in a more stable asset like property, is you can continue to leverage the equity without actually having to pay capital gains, because you can buy your next property, go to the bank, and you can leverage. They don't take into account your potential capital gains liability. They just take into account the value of the asset. So if your asset's gone up from $200,000 to $1 million, technically you've got an $800,000 gain, and you've probably got some capital gains liability if you ever sell it. But the bank will still give you potentially 80% of that, which is great. So that's how you can use the tax advantages of negative gearing, the leveraging of the property, depreciation to really build that portfolio. But I want to talk about the other thing that you mentioned earlier is the capital gains discount. So when you make a loss, you get it at your marginal rate. But when you make a capital gain, tell me how a capital gain is treated for tax purposes.
A capital gain is added to your other income. And if you've held the asset for more than a year, an individual or a trust through a pass-through will get a 50% discount. So you pay tax on half of it. So the whole strategy around property investment actually is negatively gear, large deductions at the value of, call it 1, but when you come to sell, tax on only the profit at 0.5. So that's where it really becomes attractive to a lot of people. Strong incomes, able to gear, build a property portfolio, and you come to sell, you only pay tax on half the profit.
And that's critical, albeit, and I'll talk briefly about the structures. That's a compelling component. If you and again, they talk about in the press all the time, we're going to change this, we're going to change that, but I doubt they'd make it retrospective. But right now, if you're make an $800,000 gain, half of it's excluded from your income, so you'd only get $400,000 included in your income, and from there, the top marginal rate, even if it's 47 cents. On $400,000, you're going to pay 190-ish thousand, somewhere around there. Doing the maths, 188,000 in my head. But that means that of your $800,000 gain, you effectively paid no more than 23.5%, and that just makes investing so compelling. Because if you had to pay capital gains at your marginal rate, that's a bit of a killer. Particularly if you make a big gain in 1 year, you'll be pushed into the top tax bracket. But it's just another reason, I think, for people to think about investing. The tax structure it favours investing, doesn't it? If you look at it with the capital gains discount, negative gearing, it really does encourage investment, doesn't it?
It does. And I think if I look at it from a philosophical perspective, unless you're a very high income earner, paying off private debt just with earnings actually is pretty tough. So doing some form of investing is actually really important. And if you can use a tax system and negative gearing, you can build a property portfolio and wait for the time to be right and sell and make profit along the way. That goes a long way towards building retirement savings or paying off private debt. The truth of the matter is, and you'll see it in your investors, there's this misconception that a lot of property investors are ultra high net wealth. Actually, most of them are middle income earners trying to do better by investing in property.
Well, that's interesting, isn't it? A lot of the stats from the ATO suggest that the average income of a property investor is, I think it's sub 100,000. It's not very high, and the very high percentage of people who are lots of accountants, James, do like their property, but there's also police force, nurses, other what you would consider middle income people who are trying to get ahead in life and who've chosen property, and that's reflected in the ATO stats. I think it's 2.2 million people now have an investment property, whether they might own that with a partner. But there's a lot of investors out there, and I dare say there are a lot of them like to vote. I think a government would be pretty brave to change the laws. What do you think?
In the world of pure tax policy, negative gearing is seen as a distortion. But there's always a reality we need to live with. And back to our earlier point, you can remove negative gearing, but you'll follow the trend of other countries where on a yield basis, no one's going to invest to make a loss. You're going to make profit.
Yeah.
And you've got no incentives like half the profit on a capital gain being taxed, etc. You just go back to pure economics. No one will invest in property, or your rents will increase significantly.
Well, that's it, pure and simple to me. And if anyone with any logical basis for investing, if it was costing me after tax maybe 10 or 15,000 a year, and that was suddenly going to double to 25 to 30,000 or 20 to 30,000 a year, I go, well, I can't do that. I need the rents to go up. So it's pretty simple maths, but in government policy they don't always quite work that way. Now, James, the topic today is not about structures, but I just want to briefly touch on what do you find is the structure that most of your investors choose to purchase property? What do you generally find? Own name, trusts, and maybe you can talk about why companies probably not the right way. But just tell us briefly about structures and why they should seek advice from an accountant before they buy the property.
Okay, so most commonly, if you have higher income earners in their own name, they'll buy it individually, so long as they aren't maybe in a risky profession. So maybe doctors, lawyers, accountants, they might be a bit cautious because of the personal liability. That gives you direct access to the losses against your other income and the ability to only pay tax on half the gain. The trust is an alternate structure. The downside is the loss is trapped in the trust, so you're kind of waiting till later unless, say you're a businessman and you have a structure that permits you to distribute income across a group. Trust can work very well. For a lot of overseas clients, we might advise a mix of trusts or companies, depending on their circumstances. largely because you cap the tax at a corporate rate and you send it overseas. The fourth one is probably self-managed super funds, who will do a lot of that investing as well. The arbitrage is slightly less, is 10% rate of tax on a capital gain and 15% ordinarily in a super fund. But the real kicker is if they move into pension phase, they stop paying tax altogether. So in super funds, actually, self-managed super funds, property investment can be pretty compelling as well.
Yeah, particularly in that 0% tax bracket that many of them get, although they're always talking about putting some threshold changes on that one. I think that's the other thing to think about as a property investor is, if you're a salary earner, trusts are great for business owners. Mine are all in trusts because I can use income to go from one trust to another. If you're on a salary, you can't do that. So your own name, although you've got the liabilities risk depending on your profession. And companies, the downside, of course, with companies is, particularly if you're a local Australian, is if you sell the asset, there's no CGT discount, and if you take that as a dividend later, you've lost those benefits. So, do you find? I always say to people, before you need to go and get that accounting advice before you buy the property, because once you've got under contract, the most places, if not all around Australia, have barred and banned the and/or nominee. So going back many years, you could say, "I'll buy it in the name of Damian Collins and/or nominee," and you could put in whatever you wanted before you got to settlement. You could do that. Well, the state revenue officers in most states around the country now have pretty much said you can't do that anymore. Maybe you can add a spouse to it, but if you want to put it into a discretionary trust, well, that's another transfer, and they want to sting you for stamp duty again before you even before you've even settled. They want to hit you twice: first for the purchase and the nominee, and then. So I always say to people, and you've got to get this right before you go out there and invest. You've got to go and talk to your accountant, and don't do it 3 days before you're about to buy the property, because your circumstances could be complex. You could find, and there's other things to think about. Land tax is the killer. In Australia, every state and territory is pretty much got a land tax, and the more you buy, the more aggressive the land tax can be. So what do you say to people listening to this podcast, James? How far out should they be talking to their accountant about investing and the structures? How far out before they're even thinking about getting into the market?
Anyone who's bought a property will realise it takes longer than you think. By the time you go through the process of firstly finding a property, then you do your inspections, you put your conditions in, then you obtain your finance. I would say once the thought is in your head, we would like to invest in some property, have the conversation. To your point on the stamp duty, WA has some minor clauses that you could use. In practice, though, you could end up in a fight with the Office of State Revenue. So you better just don't have that fight to begin with. Get your structures or understand how you're going to purchase it up front. Speak to your financiers as well. You need to understand, what does my borrowing capacity look like? What can I go out and buy? You don't want to go and buy a property and find partway through the process, finance has fallen over, I've missed out. You need to understand, and even the stamp duty, most settlement agents, they'll have a copy of the contract and they'll have submitted to the Office of State Revenue, and you'll have put the money in their trust account for the stamp duty well before you come to settle. So you can't be doing this at the 11th hour.
No, I think that's critical. Go and get the advice from your accountant about, and there will be thoughts, particularly if you start to build your portfolio, about land tax and maybe splitting it. And look, it might well be you buy it with your partner. It might be 90-10 tenants in common. It might be joint tenants. There's a whole raft of things to think about. So, James, any final tips for property investors? What record keeping or anything else you can think of? What would you give? What tips would you give to a property investor about investing in property and maximising their tax advantages?
And I think you guys talk to this. You have a whole advisory service around property selection. So I think speak to an expert about where you want to buy. Dare I say, don't buy in the same street as you live in. Diversify a little bit. That's important. Understand your structures. Understand your financing. If you're building a portfolio, back to your land tax comment, if you've got a few in your own name, by the time you aggregate the land tax, the holding cost is significant. Buying empty land, just be aware you've got no income, but the holding cost is actually pretty significant. Council rates are at full rack on a empty piece of land. So that can become a bit of a shock if you've got no income coming in. And I guess as an asset class, Australians still love it. And risk adjusted, I deal with overseas clients all the time. there's a reason they look at Australia, because it's freehold property, rule of law is followed, indefeasible, and risk adjusted, given governments are pretty good, although we all debate that. It's a pretty safe place to invest.
Yeah, I think good points, James. I think we don't always appreciate till you go over other countries and you look at their how once it's yours and it's freehold, it's as long as you pay the bank, it's yours. It's safe, and that's something we don't always appreciate. Look, really appreciate your time coming in, giving us some updates and tips on property taxation and a bit about structures as well. So thank you very much for coming in. Certainly, my tip on this is as well as making sure you're maximising your deductions, getting the quantity surveyor reports. The record keeping is really critical. I learnt the hard way. When I sold an investment property, when it's a capital gain, you have to have had, they say it's 7 years for record keeping, but that's 7 years from the date you sell it. So I had a property I owned for 18 years. I sold it, and I had some renovations done some 15 years prior. And then I got a letter from my friends at the ATO and said, can you show us all those renovations you did? So I spent luckily I had the records. I spent a nice weekend climbing around in boxes with my wife, she hasn't forgiven me, looking for those records. And luckily we had them. But just remember that for capital gains purposes, it's...
No time limit. Back to when you incurred all the expenditure.
So I just think always be mindful of record keeping. You've got to keep those records for a long, long time. So anyway, luckily I found them in those boxes. I didn't have to pay any more tax. But final tip: keep those records. These days you can do it digitally. You don't have to go in a box in a self-storage shed, and you just never know when you're going to need them. Thanks for tuning in. If you're enjoying the podcast, please take a moment to rate us to help others discover the show. Please note the information shared on Property Investing Roadmap is general in nature and doesn't take into account your individual circumstances. The information is for educational purposes only and should not be relied upon for investment or financial decisions. Always seek professional advice before deciding whether to invest.